Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 29th of August, 2023. And here in the home studio in beautiful Charm City, Baltimore, Maryland. What an amazing city, folks. And we got a big show coming up. We're going to talk about the bond market. Don't turn off the video right now. It's not that boring. I will tell you, there are some opportunities when it comes to income, when it comes to bonds. We're also talking about the stock market. We're going to jump into that as well. We're always going to talk about that. But there's some opportunities out there. There's some big money moving around, and it's a situation we cannot ignore. And it tells us a lot about where I think stocks are going in the future as well. All that more coming up right now on Making Money. NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see Mark Chaikin's new AI prediction first. Mark is a regular in many news outlets from Fox Business to CNBC and built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, is what Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzy23.com. Again, that's aifrenzy23.com for a free copy of his new report. Again, this is Matt McCall. Thanks for joining me. It is August 29th, 2023. As I mentioned, here in the home Baltimore studio. For many of you, you can't tell the difference when I'm in the Florida studio or I'm in the Baltimore studio because the team of Greg and Will have done such a good job. You can see it almost looks the same. Beautiful purple lighting, meant to bring out my blue eyes, I assume. But what a beautiful looking studio. So kudos to them for doing that. And also for putting up with me every Tuesday and Thursday. And my rants. You should see the real rants, folks. It happens before the show even starts. Let's jump into the market. We have the S&P up again this morning, trying to put together a 3-day winning streak. We can see if it closes here on the right-hand side of this chart, it'd be the best close in about a week and a half. And just when everybody was saying that the bull market's dead, the bear market is here, run for the exits, the market's holding up pretty darn well. So stocks holding up. At the same time, bonds have not been doing too well. And we're going to jump into that. And the reason we're going to talk about bonds today is because most of you have some exposure to fixed income, AKA bonds in some way, whether it be by owning bonds in a portfolio or a bond ETF or a bond mutual fund or some type of diversified fund or portfolio that has exposure to it. If you don't have any exposure to bonds, there's probably a reason for it. Maybe you're very young and you don't want to have any exposure to fixed income. I personally don't have any right now, but I'm a stock market guy, so that's what I do. But actually, I take that back. I do have a little bit of exposure. There's a great opportunity coming up right now, and I got a ton of charts that we're going to go through and talk about this. But before we kind of jump into the bonds, there's some really important things I want to look at here. And here's a chart, folks, of the S&P coming into today, year to date, up about 16%. And that's a hell of a return. That's well above the average annual return for a full year going back 100 plus years. So we've had a heck of a return. And that chart, I got to tell you, looks really nice. That's a beautiful looking chart. Now let's take we're going to take a look at the same time frame of the S&P 500, but in a different way. And this is showing the percentage off the highs. So when it's up at the zero level up top and it's flat, that means it's trading at the best level it's had in this time frame. And then when you see it pull back, that shows how far it's pulled back from that recent high. Again, yesterday, S&P down about 4% from that high, from the yearly high, which is pretty darn impressive. And it's even less today because we rallied into the close yesterday and we are up again today. So down a little less than 3% at the current time. So the S&P, folks, as you can see, trading not far from a yearly high. So we're going to work our way slowly into the bond market. And let's take a look at that old 60-40 portfolio. And for those of you who don't know what that is, it's been around a long time, used by many, many managers as kind of a conservative way of investing in the overall market, fixed income and stocks. 60% goes into equity stocks, 40% goes into bonds. For this, I'm showing the S&P 500, which is up about 16.6% year to date. This was taken obviously yesterday, so it's got a little bit higher return. And this is the total return with dividends as well. That's why it's going to be a little bit higher. And then we look at the lower line, down 1%. That is the U.S. Aggregate Bond ETF, AGG. So that's really the best widespread indicator for the U.S. bond market, down 1% this year. And then the 60-40 right in the middle at 9.6. So even if you're doing a 60-40 this year with the bond market down, stocks have done so well, you're actually holding up pretty good. But let's go back over the last 5 years. S&P up about 67%. Bonds only up 1.4%. And that is with dividends as well. My goodness, bonds have really, really underperformed because obviously, as we'll talk about, when yields go up in bonds, prices come down. I'll tell you why in a minute. And right in the middle, up about 40%, is the 60-40. So you can really see here what has been leading the way. And it's been led really by stocks. Even though it was a rough 2022, you have to keep in mind that in 2022, it was really bad for bonds. And let me show you something here. And this is a pretty amazing chart. And it's going to lead into why I think there's an opportunity in fixed income right now. This takes a look at the return of the 10-year Treasury bond going back to 1928 every single year. First of all, the first thing I notice is, even though I've once been told I'm colorblind, but I can tell the difference between red and green. Trust me, I've been in the stock market long enough. I know when something's red, I know when something's green. There's a lot more green on the screen here than red. One thing I do notice, prior to the last 2 years, 2021, 2022, 2023 is not open, so I'm not, or closed, so I'm not speaking to that yet. Prior to that, since 1928, there's only been 2 instances where it's been consecutive years of the bond market being down. That was 55 and 56. It was down 1.3% and 2.3% respectively. We were up 6.8% in 57. Then in 58 and 59, the 10-year bond down 2.1% and down 2.6% respectively. But then we bounced 11.6% in 1960 and didn't have a down year until 67. You can see that typically the green numbers aren't that big. They've gotten bigger in the last couple of decades, but they're usually not that big. But we were down in 2021, 4.4%. And then in 2022, down 17.8%, the worst number on here. If you talk to some people, they'll tell you it was the worst year for the U.S. bond market since the Civil War. Think about that. The Civil War. We know for sure for the last last century or so, it's been the worst year by far. By far. There's only been one other year it's been down double digits in 2009, down 11.1%. When rates went up. And you can see here, 17.8. That's pretty ridiculous, folks. And I'll tell you why that's happened. Because as bond yields go up, prices of bonds fall. Why does that happen, Matt? Well, because as yields go higher, it becomes it's more attractive. So let's just say, for example, the yield was 1% 2 years ago, making up numbers. I'll show you real numbers in a second. 1% 2 years ago. So that's not very attractive. I'm not locking in for 10 years at 1% a year. That doesn't sound very good. It suddenly shoots up to 4.5%. Now it's attractive. As those yields go up, more money are buying into bonds and locking in that rate. So there's an inverse relationship to the yield and the price. As yields go up, prices go down. As yields start to come down, prices go up. And I'll show you in a second how many people are betting on the second thing I just said. The yields coming down and prices going up. Before that, let's show you why bonds have gone down. And this is going back about 3 years. And this is the rate, the yields of the 2-year, the 10-year, and a 30-year. If we go back into 2020, 3 years ago, you can see the yield in a 2-year not far above zero. Now it's at 5%. 5%. The 10-year was down a little bit below 1. Now we're at 4.25. The 30-year was right around 1.5. Now we're at 4.3. Those yields going up like that has resulted in bonds going down. I'm going to show you a chart of TLT. And this is one of the really most well-known and owned bond ETFs. This invests in bonds that have maturities 20 years or more, so the long bond. You can see here the underperformance that we've seen on TLT. And I'm going to zoom out even more and show you longer term. TLT, since topping out in 2020, around $178, $79 a share, now at 96. So if you would have bought into TLT at the end of the first quarter of 2020, around 178, you're down to about 96 right now. Throw in some dividends, you're probably down about 40%. Thinking you're buying into a long bond ETF, a long bond fund. I can never lose money on that. Contrary, motherfucker. You could lose a lot of money on it, down to the tune of almost half your money. In a bond ETF, a long bond ETF. People sometimes forget that there's risk with every investment. And that's why you must diversify. However, folks, I do see right now, and here's a chart of that TLT again, down around that 96 level, down near the bottom that we had in October of 2022. I think we can rally up to that another level around 110, which is the high that we've had since the pullback, really big pullback in mid of last year. That 110 level, I think, could be attainable. And that's about 14 points from here. So we give that, 15, 16%? That's a huge gain in a bond ETF. But I think it's there. I think it's there for the taking. And again, nothing here is a buy or sell recommendation. I'm just telling you, I think bonds are set to rally. And, normally I like to be in an area where I'm the only one who thinks that. But I look at the Bank of America fund manager survey that comes out every month. And the one for August, I'm about to show you a chart here that kind of blew my mind and made me a bit concerned. But I still like this investment. Let's take a look at this. This shows, actually, this one's from Bloomberg. Sorry, this one's from Bloomberg. This shows how investors are positioned, and they believe that the yields will fall, which means bond prices will go up, very similar to me. This is the asset manager net long positions in the 10-year, which we were just looking at. Look how high it is. This is going back to 2005. It's the highest it's been since 2005, the last 18 years. That means people are piling in and buying the 10-year bond. They believe that yields will fall on the 10-year, and at the same time, we're going to see 10-year bond prices move higher. So this doesn't really surprise me because I'm seeing it too. So I looked at the last spike that we saw. That spike, that was about 2017, 2018, and then we obviously came down right before COVID. And if we take a look back at bonds at that time, bonds were actually working their way up. So I still think there is some upside here. As a contrarian, it still does concern me. Because as a contrarian, I'd like to see this trade empty, not crowded. Because usually a crowded trade doesn't work too well. This is one time I'm going against what I would normally do. Because I really, really believe that there is a situation setting up where bonds will outperform. So here's a chart from that B of A, Bank of America survey that I discussed a moment ago. This here shows that the net percentage of investors that expect lower long-term rates. Again, thinking rates come down, so you want to be in bonds. That percentage just goes back to 2003, so 20 years. Spiked in April to the highest we've had on record for the last 20 years for this. It has come down a little bit, but it's still extremely high. That the expectations for lower bond yields not far again, as this chart shows, from 20-year highs. So again, this is a bit of a crowded trade, but I'm okay with it, believe it or not. I am actually okay with this trade. I'm going to show you another chart here from that same survey. This shows overweight, underweight, different asset classes around the world. What is the most overweight right now? Bonds. Overweight. It just is just reconfirming all the things I've said. What are the two most underweight? Which is a contrarian. I love that. REITs and equities, stocks. So again, I like actually long equities and long bonds here. And I think the 60-40 portfolio, for those of you who that fits into your style, is actually a pretty damn good place to be right now. I'm not saying buy and hold it, but it's a pretty damn good place to be right now. And the last thing I want to show you here, and again, this makes me bullish on equities. And this shows the sentiment that's been the least bearish that we've had on the equity market since February of 2022. So again, a contrarian may say, wow, we're not as negative as we were, which was the most negative we've been this entire century, the 21st century, that is. But look, normally when we bounce back like this, it runs for years. So to me, we hit a bottom. We're about to run for years. I mean, this looks pretty damn good to me. So even though that has shifted and more people are getting into equity, even though extremely underweight, I still believe there's a lot of upside here left when it comes to that. When we talk about interest rates and the Fed, obviously, which has a lot to do with interest rates, we have to realize the effect that it has on us as investors, as homeowners, as potential homeowners, as borrowers, on governments. So let's take a look at the chart here, the 30-year mortgage. And it's now at the highest level that we have seen going back to the early 2000s and above 7%. And you can see how much it's come up just in the last year or two. But again, I wasn't buying a home in the 70s or early 80s, but my parents were. And I've heard stories, and I've obviously done a lot of research on this, of how high mortgage rates were then. High teens, mid-teens. So 7% isn't the end of the world. And another reason why I've been saying that this is not going to bring down the housing market, even though a lot of people, I'd say the consensus says the high interest rates will, high home prices will. Well, here's a great chart. And this shows the share of outstanding mortgages by interest rate at origination, which means how much your mortgage rate is when you originated your loan. Almost 2/3 are below 4%. They're locked in at great rates, amazing rates. Almost a quarter are below 3%. That's amazing. And even if you go 4 to 5, over 80% are 5% or below. So this has caused a lot of issues. And I'm not going to get too much into the housing market. I'm going to do an entire special on the housing market here very soon. But this has led to low inventory, because if you're locked in at a 3 or 4% mortgage or below that, as about 2/3 of borrowers are in the United States, it's very difficult for you to sell if you're going to originate another mortgage to borrow to buy your next home, because you're borrowing at a much higher interest rate. And that much higher interest rate is going to make you be able to afford less of a home if you're looking for the same payment, because you're paying a lot more in interest. So you're seeing a lot of people sit on the house. The good news is most people have a ton of equity in their house, because as prices have gone up, they're locked in at low interest rates. The job market is very strong right now. Real wages are going up once again. So this isn't 07, 08. It just really isn't. And another way to look at this is the U.S. median housing payment as a percentage of median income. It has gone up. You can see here. So your housing payment is higher than it's been. So that could be considered a concern. But what I'm going to show you here tells me, and this is coming just from the stock market aspect of it, that we're fine. And this is a chart of the ITB, the iShares U.S. Home Construction ETF. And this shows, going back, percentage pullback. Let's go back here to 07, 08, 09. That ETF in a true housing bubble, because people are so leveraged, saw this ETF pull back 86%. 86% of its value. I remember being on Fox every single day talking about home builders, thinking that D.R. Horton and some of these others are going to go bankrupt. Bankrupt. Now look at ITB. It's 8% off an all-time high. Off an all-time high. That tells me something. That tells me that we're not close to anything of a housing bubble that we had in 07, 08, 09. That really was a precursor to the GFC, the Great Financial Crisis. And again, folks, we take a look at just where the market was there. I'm just going to show you D.R. Horton only because I owned my first home ever built in Denver, Colorado, was built by D.R. Horton many, many moons ago. So that's the first one that popped to my mind. It's the only reason I'm talking about it. Look at a chart here of D.R. Horton. You see right there, 07, 08, 09. But what happened? That stock peaked in 05. These home builders are already starting to see a slowdown, and we're not seeing that right now. We're not seeing that at all. So you can see that pullback. And since that time, and D.R. Horton was in a $4 range, went up to a high of 130 earlier this year. And again, we're pulled back 8%. Big deal. We've had that's not a breakdown. It's an 8% pullback after a stock here and a sector that has done so damn well. That's okay. We can't go straight up. So again, just another sign, in my opinion, folks, that we believe, when I say we, the market believes that we are going to see a pullback in interest rates. And I think it's something that is going to happen sooner rather than later. So real quick, the Fed meets next on September 20th. There's currently about a 20% chance that the Fed will hike interest rates by 25 basis points at that meeting. There's a lot of economic numbers, inflation, employment numbers that come out between now and then, GDP that could sway that one way and the other dramatically. But I'm just saying the market's got about a 1 in 5 chance right now. If we go ahead to the November 1st meeting, the second meeting from now, there's about a 58% chance saying that it'd be at least interest rates would be 25%, 25 basis points or higher. So a little over half of a coin toss there. And about similar for December 13th meeting, which is the last of the year. So there's about a coin toss chance that between now and the end of the year, the Fed raises interest rates one more time. Last week in Jackson Hole, Fed Chairman Powell came out and basically said he vowed to fight inflation. It really hasn't changed the odds that much because he's really been saying that for a long time. I'm at a coin toss here too. I don't know what the ultimate decision will be. I would not be surprised if we have one more 25 basis point hike between now and the end of the year, and that's it. I would not be surprised if we don't have any at all. And I don't think the Fed really knows right now either when it comes to that meeting. And again, that meeting is 3 weeks away? Not too far. We're going to have another employment number before then. That could be important. So we got to keep an eye on it. But I will say this. I'm fairly certain there's only one more 25 basis point hike between now and the end of the year, which means I think rates are topping out, if not topped already. They're ready to roll over. And let me show you a chart here real quick of the yield on the 10-year. And I'm going to show you why I think we've topped out here. And look at this, folks. You can see back in October, we hit a multi-year high in a yield. And we just hit it again about a week and a half ago. And we're now rolling over. I think we've topped out. I think yields are going to start coming down. The inverse to this, obviously, would be bond prices going up. So again, I think there is an opportunity here, and I think it's underway and it's begun. Even though this is a very crowded trade, there's very smart people on the other side. Bill Ackman, one of them, the billionaire hedge fund, he's going the opposite way. He's shorting bonds and thinks the yields continue to move up. And there's some big names out there doing that as well. So this is a very contentious trade right now. I'm on the side. Yields come down, bonds go up. I have some money in it. And I'll tell you, I think I'm going to ride it for another couple of weeks, and we'll see how it plays out. So again, nothing here is a buy or sell recommendation, sharing some education with you, trying to have some fun, and ultimately making some money. So, folks, thank you so much for watching. We have a great interview coming up Thursday, diving back into energy, oil, and gas, an interview that I got when I was out at that conference in LA last weekend. So I look forward to that. Make sure you tune in on Thursday. Until then, have a great couple of days. Be safe, be happy. Go out there and give somebody a hug. Spread the love. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.